Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton live from our New York City headquarters. We've got 1 hour to go until the market close, and we're taking a look at the major averages sponsored by Tasty Trade to kick us off here today. We got some economic data this morning that is putting pressure on stocks. One, Conference Board consumer confidence reading that came in at a 2-year low. So bad news being read as bad news at the same time that we got an employment cost index for the first quarter that showed a bigger increase than had been anticipated in wages and wider compensation. So we've got the Dow down today by 428 points or so. That's good for a drop of 1.2%. The S&P is down 1% as well, and the Nasdaq down 1.25%. I've been watching the bond market as usual as well. There we are seeing an uptick at yields, not to the recent highs where we have seen them, but in that direction, up by 7 basis points today. So if we look at the sectors and how this is all playing out and percolating through, we actually have energy down the most today. It's under pressure also by some disappointing earnings within that sector from the likes of Anadarko Petroleum as well as Transocean. We've got consumer discretionary under pressure, materials, industrial. So it's a pretty broad-based sell-off that we are watching today, at least from the sector perspective. And then let's take a quick look at the Nasdaq 100 as well, because of course we are also awaiting some big earnings still from the tech sector, from the likes of Amazon, which is falling 1% ahead of those numbers. We're going to dig more into what to expect there in just a few moments. But you can see tech in particular under some pressure. And guess what? Tesla, which of course has been rallying as of late, that rally coming to an end today, Josh.
Julie, stocks lower today as we wind down what's looking like the worst trading month of 2024 so far. So the question lingers, should investors be prepared to sell in May and go away? Or could we see a rebound coming? For more, we want to welcome in here Sandy Villery, portfolio manager at Villery & Company. Sandy, it is good to have you on the show. So we got some red on the screen today, Sandy, but what do you see for the market in kind of the near to intermediate termers? Sandy, tomorrow is May 1st. Sell in May and go away. It rhymes. It must be true, Sandy. Is that the smart move for investors?
You know, the old adage, sell in May and go away, is kind of accurate, right? I mean, if you look at the seasonally weak period from May through October, it's underperformed the seasonally stronger period, November to April, by about 6% or so. So when I'm looking at investing in stocks, though, or selling, I rarely look at any calendar month. We're long-term buy and hold. So I'm not going to go with the old adage, but there is some truth behind it.
Yeah, especially since we're coming off such a weak April as well. So maybe this time is different. So as we look at the setup, and I know you're longer term, but we have seemed to have seen a real sentiment shift as of late in the markets among consumers, as we just heard from that consumer confidence read. Does that make you sort of less optimistic about the trajectory for stocks this year?
Yeah, it definitely seems like there's a risk-off trade. I mean, everybody's trying to figure out what the Fed's going to do and what they may say tomorrow. But just based on the data, even today, the employment index, I mean, all of a sudden, prices are just stubbornly high. You know, last week on Thursday, we got the PCE, the Fed's favorite inflation gauge, and, you know, coming in at 3.4%, you know, versus the quarter before at basically, you know, 1.8%. So they got to get inflation under control, and I think that's what you're going to hear a lot from Powell tomorrow. And you know, it doesn't look like rates are going down any time over the short to intermediate term.
What's in your view is the risk actually that maybe we actually see a rate hike? You know, some people like Larry Summers seem to suggest that's a real possibility here.
Yeah, I don't see a rate hike. I mean, I do see maybe one cut this year. I think probably consensus is somewhere around September. I'm thinking December. What I would like to hear tomorrow is a little bit more on the quantitative tightening. If you remember back in June of 2022, the Fed's balance sheet was around $9 trillion. They've been working off about $100 billion a month, down to about $7.4 trillion today. But I'd like to hear something from him that could say, look, maybe in June we run off about half that amount, and maybe it puts a little less pressure on rates.
Sandy, as you mentioned, you're buy and hold guys, and so as always, you're looking for the right stock to choose. It caught my eye that you guys like Freeport-McMoRan because we have seen some volatility in some of those underlying metals prices, right? So why is it, and are you adding to your position in FCX right now, and why?
Yeah, so we do like Freeport a lot. In fact, we just had Richard Adkerson in our office on Friday here in New Orleans, and he just lays out the case for the supply and demand. There's so much demand coming from the electrification of just about everything, right? Electric vehicles use 4 times the amount of copper as a typical combustion engine car. All these, server warehouses, et cetera, that are building out artificial intelligence, they all need copper. And then on the supply side, very hard to put more mines into play. We just saw BHP go after Anglo American. I mean, that was a $39 billion bid that was denied, or that they turned down, and that's to go after their copper mines. So copper keeps creeping higher. I think the supply demand is in the favor of prices working higher. And so, we've owned it for 2 years, and we would add to it here as well.
Here's another name interesting, Sandy, IDEX Laboratories. So this is this for the pet lovers out there, I take it?
Yeah, I mean, this is for anybody that loves their pet at home. They sell analyzers, and basically it's a great razor blade business where once you have to get a test to go test your dog or cat for any sort of thing, they're going to run it through their analyzers, and they make revenue on that. So when I bring my little animal into the vet, I'm not asking how much it costs. I'm just saying get it done. So it's a great business. It's always been a little bit expensive, but on any dip that you might see, in a choppy May, I would certainly add to IDEX here.
And those shares have dipped this year. In fact, they're down about 11%. So I guess you've had some opportunity to add there, Sandy. Thank you so much for being here. Got to leave it there. Good to see you.
Thanks for having me.
As we mentioned, tech giant Amazon is set to report its first quarter results after the close today. With more on what investors will be watching for, we are joined by our Akiko Fujita. So give us the big themes that we're looking for.
Yeah,
here.
One of the last of the Mag 7 stocks to report here. Investors have largely been cheering on some of these big tech stocks up until now, with the exception of some. But there's been a key concern that has emerged here, which is the amount of investments, the sheer scale of investments that's needed to really scale up on AI. And that's certainly going to be a big concern going into Amazon's results as well. Let's take a look at the numbers here, what the street is expecting. Adjusted earnings expected to come in at $1.23 a share, revenue at $142.6 billion, and then operating profit at $10.9 billion there. The 3 key things analysts are watching. Number 1, as we said, AI initiatives. Andy Jassy in his recent shareholder letter saying he believes generative AI will be the largest tech transformation since the cloud, potentially the internet here. And the question is going to be, how much will it take for Amazon to get there? Just last month, we saw Amazon increasing its investments in AI startup Anthropic to bring its total investments to $4 billion. No question the talk about AI going to feed into the question about Amazon's cloud service, Amazon Web Services here. Amazon looking to use AWS's dominance in the cloud market to get ahead on AI. The street's expecting revenue for AWS to come in at $24.1 billion. And the third thing to watch here is the potential for a dividend. Amazon and Tesla, the only Mag 7 stocks that do not pay a dividend. Certainly going to be some pressure building here for Amazon to follow the likes of Alphabet last week. You saw Meta before, flexing their earnings power, as they say. But what's interesting? I'm looking through the numbers here. Monetization of AI. It feels like every quarter we say it's the show me quarter. And it's certainly been the case when you think about where the stocks have popped. Meta saw $400 billion sell-off last week. You guys reported on that on the back of an announcement that, look, they're going to have to pay up as much as $10 billion to cover the cost of AI investments. Microsoft talked about a $14 billion investment here, but their stock popped. Alphabet, same thing. So it really is about messaging, as it is every quarter, but AI investment is certainly going to be key because investors want to know when the return's coming.
Yeah. Capital return is so interesting, Akiko, because I wonder, if Amazon added a dividend, everybody likes a check in the mail every quarter, but I wonder how Amazon investors think about that. Is that what they would want? Or would they rather see Jassy just invest?
Yeah, Amazon is an interesting company in that way, right? It's easy to say, look, if you look at all the tech names so far, why is Amazon sort of holding out? You've got Tesla on the other end as well, but as you say, investors like a reward.
Yeah.
And given the earnings power that they have shown, maybe there's a little pressure there for the company.
And I remember seeing an interesting stat tied to when Alphabet made its announcement. I believe it was from Savita Subramanian over Bank of America, just measuring the sheer vast equity income ETFs and funds that then can add a company that pays a dividend once it starts paying it. So there's a lot of money that can chase, not just like you and me who likes checks in the mail, but also these big funds that chase that money.
We'll be watching.
We
after
will.
the report today.
Thanks, Akiko. Appreciate it. We're just getting started here on Market Domination. Coming up, Edward Norton, actor, filmmaker, and the co-founder of a board presentation software startup, Zeck. He'll join the show to discuss the company and its latest series of funding later in the hour. Plus, earnings season rolls with another round of big names after the close today. We will be busy. Amazon, AMD, Pinterest, Starbucks. And we'll also get some insight behind a few earnings reports with CEOs from Mondelez and F5. We will be busy, as I said. Stay tuned. All that and more when Market Domination returns. Cannabis stocks soaring on a report the U.S. government will reclassify marijuana as a less dangerous drug. According to the Associated Press, the Drug Enforcement Agency proposal will make marijuana a Schedule III controlled substance. That proposal does still need to be approved, and it does not legalize marijuana for recreational use nationally. But this is a loosening of decades-long restrictions. Joining us now, TruLeaf CEO Kim Rivers, which owns dispensaries, both medical and recreational, in a number of states. Kim, it's good to see you. Talk to us. This is something that was sort of, optimism was rising that this would happen, then it seemed to be falling. Now it looks like it's getting closer to reality. What effect is this going to have on your business and on the broader industry?
Yeah, thanks for having me. So certainly this has been a lot of ebb and flow, as you say. This has been a long process, and is the last official action required by the department, the DEA rather, in this multi-step process. So we had, of course, President Biden initiate the schedule review back in October, a while back. Then we had, of course, the HHS, with the help of the FDA, come out and make a recommendation formally that cannabis should be rescheduled from a Schedule 1 to a Schedule 3. And that was backed by a very evidence-based report, 200 and something pages, that basically compared the medical benefits along with the reduced harm consequences of cannabis as compared to other scheduled substances and alcohol in that recommendation. And then that recommendation went to DEA, and DOJ has been reviewing that recommendation against their set of criteria, primarily focused on public safety. And so, we are very hopeful and looking forward to an official announcement by the DEA that they do in fact agree and concur with HHS, and that they too are making the recommendation for a rescheduling from Schedule 1 to Schedule 3. So that means that cannabis would be on the same level as, for example, Tylenol with codeine in it, along with other substances. I think importantly, the FDA findings were actually that marijuana is safer in many respects than alcohol, which I think is very interesting in terms of having that on the record. But what it will do as it relates to, of course, changing the course of policy in this country that has existed for the last 50 plus years, it really is a critical first step as we think about additional regulatory and policy changes for the industry. It is significant that research would be allowed for cannabis products, which has definitely been lacking in the United States. It would open a pathway for pharmaceutical companies to do additional research and to come to market with FDA approved drugs. And then finally, and importantly for our industry and for my business, is that it would put us in a normalized tax bracket. Currently, state-regulated, state-authorized cannabis companies pay, in some cases, 50% tax rate. And so it would allow us to take those dollars and invest them into our companies for job growth and for additional research that we could do as well to better the industry.
And so, Kim, so important potential sort of impacts here in terms of research and taxes. I was also reading, Kim, this could potentially spur more moves in Congress. Is that accurate?
Yeah, that's certainly our hope. As many who follow the industry know, that we have been stalled in Congress in getting past the safer banking bill, which would, again, we're talking about normalization. So that's really, we're on a quest for normalization as a business and as an industry. And so that would level the playing field as it relates to banking, and importantly, would allow for us to potentially take credit cards so we wouldn't have to have as much cash on hand, which makes us a target, of course, for crime. And there have been some horrific reports of robberies that have happened in dispensaries across the country, and also would allow us to have access to banking tools. So loans, when we think about small businesses, minority-owned businesses, being able to really compete in this industry, having access to those banking tools that incentivize those businesses to get off the ground. So lots of implications we think here, and really important and critical first domino to fall if in fact it does come to fruition.
So Kim, I think what you just said, that last comment, the first domino to fall, is an important thing to understand here, because it seems as though, while significant, that this is incremental. Do you think that this is the first step on the path toward safe banking and then eventually federal legalization?
Yeah, I mean, I've always personally believed that this is going to be incremental, and that's how we typically do big policy change in the United States. Is it typically is incremental, and we tend to make a move and then learn from that, right? And then again, here, importantly, it really is important to have the science and the data behind the changes. And again, that's one of the things that we were so excited about with this process, is that we now actually have FDA-backed data points where we can have a more robust, scientifically backed conversation about what cannabis is and what it is not, and again, begin to develop a more thoughtful and comprehensive regulatory regime that can be rolled out eventually, right, nationally. And so I think, today, of course, as you know, we have, 38 states that have some form of medical marijuana available and 24 states with adult use programs. So, the scales are beginning to tip here, and it's great to see that hopefully the federal government is entering the conversation in a more meaningful way.
Big, important story, Kim. Thanks for helping us walk through it. Appreciate it.
Yeah, no problem. Thanks for having me.
GE Healthcare reporting earnings today for the first time since it spun off in January. For more on the results is Yahoo Finance's Anjali Kamlani.
Yeah, really bad news for GE Healthcare. That stock really taking a beating on really negative results. Revenues at $4.6 billion. That's a decline of 1% compared to the quarter last year, and well under estimates of $4.8 billion by analysts. We also know that this is a really interesting environment for medtech. Generally, the sector has been kind of soft and suffering, and GE Healthcare is no exception to that. The company did spin off in early 2023 from the broader GE company, and was about a third of the business there. And you can see how this spin-off isn't really working out too well, and that's what investors are saying. But we did hear from the CEO earlier today on earnings saying that they are looking at the second half of 2024 to get back on track and deliver some more positive business. They did reiterate guidance for the rest of the year, so maybe there's some hope and wait to that there. So that's where things stand for GE Healthcare right now. Just a wait and watch. They are involved in a number of really buzzy segments like Alzheimer's disease, as well as other medical, imaging and devices. So it really just a wait and watch for this one.
Yeah. Let's get to another story that you're watching closely. Walmart shutting down its health clinics. Now, the company had invested a lot of money in this area, kind of big splashy rollout. Was this a surprise, and what happened?
Yes and no. Okay. It was a surprise in the timing of the announcement. They had just recently reiterated plans to expand to a number of states. They already had 51 locations in 5 states and were looking to expand beyond that. But what wasn't a surprise is the fact that they were struggling. Now, there have been experts that have been telling me for some time that retail health is not a walk in the park. It is complex. You have to deal with the very complex payment structure of the healthcare ecosystem that we all know has been putting pressure on providers, and that is the reason why hospitals and doctors, for example, say that they have such razor-thin margins, and so Walmart bumped into that. Now, they did not explain how long this segment had been unprofitable, but it certainly is interesting, and some are saying, could this really be the end of retail health? If Walmart can't make it, who else can?
Very interesting. I know you'll continue to track it for us. Thank you. Appreciate it. Let's check out some other trending tickers right now. We got to check on Chegg, the education company, sinking as AI has been stunting its growth. The ed tech company delivering disappointing second quarter guidance. Also announced a new CEO, and this was quite something because, Josh, as you and I talked about, Dan Rosensweig had been the CEO of the company for 14 years. He's moving to executive chairman, but he's sort of like a connector, a mover and shaker, knows a lot of other CEOs. He's a very social CEO. So it's interesting to see him step down here. And the company going to be replaced with an insider, Nathan Schultz, president and CEO as of June 1st. But still, it's AI is making things tough for this business.
The commentary out of the street, Julie, some of it was just absolutely brutal. Brent Till at Jefferies, who we know well, he cuts to underperform, so he goes to a sell. The company, he told his clients, spiraling with no stability in sight, calls out AI, to your point, as a real threat to the business. Questions whether Chegg, he says, can return to durable growth given the proliferation of these free AI tools.
Yeah. Let's get to some breaking news right now as well. Binance founder Changpeng Zhao, better known as CZ, sentenced to 4 months in prison after he pled guilty to money laundering violations last year. Prosecutors had asked for 3 years in prison. CZ's defenders had asked for no time in prison. He is, by the way, the second major crypto executive to be sentenced to prison this year after, of course, FTX's Sam Bankman-Fried here. And basically, the charges against him was that he did not establish effective, comprehensive anti-money laundering barriers, if you will, for his trading platform. So that's what this has to do with.
Yeah, and listen, he did build this company. I mean, it was the hub for the crypto market. Judge saying here, by the way, in his statement, you had a responsibility to comply with United States regulations, not some, but all. You failed at that opportunity. And
as part of this, he will no longer be CEO of the company, although he is still the largest shareholder in Binance. So that's something to keep in mind. And, you know, Binance still remains a force within the crypto world.
Yep, for sure. Moving on, your turn. Sorry, I was so excited. I almost hopped in.
PayPal. Let's talk about PayPal. Reporting stronger than expected results in the first quarter this morning. The company also raising its 2024 guidance. And our next guest says that initiatives put in place by CEO Alex Chriss, who took over last September, are already bearing fruit. For more, we're bringing in Moshe Katri, equity research analyst of IT services and payments at Wedbush Securities. It's good to see you here. A very different sort of tenor when it comes to PayPal here. What do you think that Chriss is doing that is working at PayPal?
Good to be here. I would say Chriss and his team really are, I would say they're getting it in terms of what needs to get done. And I'm talking more about the enterprise merchant business, the SMB merchant business, and on the consumer side as well. And it's all about monetization, and it's all about building this ecosystem of product and services and using it as a retention and monetization kind of tool. And we started to see that kind of, we saw better TPV numbers, better take rates. Obviously, when you're pushing in value-added services, you get better margins, and I think that also helps take rates. Transaction margins were better, and overall transactions were better as well. So I would say that this is very preliminary and very early in this, what we call a transition year for the company. But they're definitely doing a great job on the value-added services side in terms of trying to monetize it. And I don't know if you guys are aware, but everybody's talking about value-added services in the industry. And even Stripe, that had a user conference last week, is talking about decoupling value-added services from payments. And today you can actually go and buy value-added services from Stripe without actually having to use their payments platform. So this is becoming a very, very important, I would say, enhancement to revenue growth in general for this industry and obviously for PayPal.
And Moshe, I'm interested. I think your target here is it's 85. Moshe, how did you get there? How did you arrive at that target?
Well, we're looking at $5 in earnings power and putting in a 20 multiple on that, maybe 22, 23 multiple on that.
And Moshe, to go back to what you were talking about with value-added services, what exactly, for people who are not familiar, what exactly are we talking about here? What are these value-added services?
Sure. If you're a merchant, we're talking about a bunch of different applications that are needed for your daily operations, anywhere from inventory management, receivables, rewards, payroll processing or payroll, and obviously capital. These are all things that you need to operate your business. And if you're able to use, for example, PayPal as a one-stop shop for that, you should be able to kind of unbundle that business, which is value-added services, from the payments piece. Look, core payments in general, the way I see it, is kind of a business that's becoming more commoditized. And if you really want to do better in terms of margins, you have to be able to sell all these services on top of the core payments kind of business. So that's on the merchants piece. And then remember, PayPal kind of divides it into two segments. One focuses on enterprises, i.e. larger merchants. And this is where they're doing really well in terms of transactions because of, all these merchants are using Braintree, which is a platform that helps them process those transactions. But the problem is that pricing there has been under pressure. So they're trying to kind of change that by selling these value-added services on top. And then you also have the SMB piece, which is relatively new for PayPal, and trying to kind of build that ecosystem of products and services around that. And we're starting to see some positive results there. And then on the consumer-facing platform, and this is where you have the digital banking product, or what we call the PayPal app, or the super app. And this is where you do anywhere from money transfer, bill pay, Venmo, which is P2P, all these things that you should be able to kind of cross-sell into roughly about $500 million consumers that are using the platform. This is the way I see it. Before this leadership came on board, I would say PayPal was probably the least utilized platform in the space, and it's pretty sticky. 35, 36 million merchants that continue to use the platform just because it has very high conversion rates. All you have to do is kind of build that plan to be able to sell those value-added services on top of the core payments platform. And then, 500 million consumers that are using the digital app, and you should be able to do the same thing, replicate that strategy there as well.
Moshe, always love having you on the show. Thanks so much for joining us.
Thank you.
Coming up, we're speaking to actor and filmmaker Edward Norton about his board presentation software startup Zeck. On the other side, stick around, much more market domination still to come. Shares of Warner Brothers Discovery down big today on the back of a report that NBC Universal is prepared to pay an average of about $2.5 billion a year to air a package of NBA games. This is according to Wall Street Journal. Yahoo Finance's very own Alexandra Canal is here with more. Allie.
Yes, we knew this day would come, the NBA media rights renewal, and Warner Brothers Discovery's TNT network. They've had the rights to the league for quite some time. They were shelling out $1.2 billion, but it looks like they're going to be eclipsed by by NBC. Now, this report from the Journal says that NBC is nearing a deal to pay $2.5 billion a year. So that's more than double what Warner Brothers Discovery is paying. The package would reportedly include playoff and regular season games that would air on the NBC network, along with the company's streaming service, Peacock. Now, we did have that exclusive negotiation window last week. Warner Brothers Discovery unable to strike a deal there. Disney, which is the NBA's other major broadcaster, they have reportedly agreed to increase their payment of $1.5 billion a year to $2.6 billion in order to secure the deal. So we're just seeing these sports rights across the board really balloon. A big part of that has been the big tech players like Amazon, YouTube, Apple. They have been increasing their commitments to sports-related content. Amazon is reportedly in talks with the NBA for a streaming sort of partnership. We do know that Warner Brothers Discovery has that separate joint venture sports network coming out with ESPN and Fox. We'll see how this could potentially affect that JV deal, since the NBA rights that Warner Brothers Discovery had, that was a very attractive opportunity for the JV. So lots of moving parts here, but definitely an interesting development as NBC and really all of these legacy media companies are looking to compete with those tech giants.
Speaking of lots of moving parts, tell us the latest on Paramount. The share's falling today. We got the earnings last night. We got the confirmation that Bob Bakish would be leaving as the CEO. And then he also posted on LinkedIn a message after he left.
Yeah, so when we got the announcement that Bob Bakish was exiting the company, he did not appear in the earnings call. In fact, the earnings call was just about 10 minutes long.
They didn't take any questions,
They didn't take any questions.
Well, it's good because no one really has questions. So that's
right,
that
exactly. The one thing everyone really wanted to know, they did not address. He was not present anywhere in the release either. So this is the first time that we're hearing from him since his exit. He did speak very fondly about his experience. He said that they were navigating a period of unprecedented change for media and entertainment, that he's grateful for the 27 years that he's been at this company. And look, we knew heading into this earnings report, there had been multiple media reports coming out that he was going to be exiting his position. Now we have this consortium of the Office of CEOs that include 3 division heads. But this all comes amid those deal talks with Skydance. Our parent company, Apollo Global, has also been in the mix there. The exclusive negotiation window with Skydance expires on Friday. So hopefully over the next couple of days, we get some sort of announcement or indication whether or not a sale is going to go through. But then you have those regulatory challenges as well hanging in the background.
You do.
So,
Allie, thanks for keeping
always
on
never
top
a dull
of it.
moment.
No, definitely not. Thank you. Appreciate it. Well, actor, filmmaker, and entrepreneur Edward Norton is now placing the spotlight on leadership teams through a $7.5 million investment led by Salesforce Ventures. Norton's software company Zeck is stepping outside the box with board meetings. Joining us here to discuss is Edward Norton, Zeck's co-founder. Thanks for being here.
Pleasure.
So Zeck is basically a different way to present ahead of board meetings, to disseminate the information that people absorb at board meetings.
Yeah, exactly. I mean, I think if you look at the way that we've transposed a lot of corporate functions, from fixed tools to cloud-based iterative software tools, no young company manages its cap table with Excel anymore. They do it on Carta, right? And you don't get FedExes full of legal documents with signature tabs. You get them in DocuSign. And this incredibly important function of organizations, and not just corporations, but nonprofit organizations, is its board, right? And it's supposed to be a very primary relationship, a relationship that's supposed to help advance the interests of the organization. And yet we still use these incredibly regressive tools. And I'll give an example. I recently got on a board I sit on a 90-page PDF that was sent to me, about 36 hours before the meeting. You slog through it with no capacity whatsoever to ask a question, query, flag anything, vote on a minutes approval or something offline. You get into the meeting, and we had the CEO read us back, across 4 hours, the thing we'd read verbatim, because he has no idea what we've read or what we've ingested. And this is absurd in 2024, and it actually, I think it wastes human capital. It promotes kind of negative relationships between management and board. And I think most management of most organizations will tell you that the 2 weeks that they go pencils down to get ready for a board meeting, they just want to punch themselves in the face. And I think we a lot of people have said to me, like, you have a really interesting day job. Why are you working on a board, management software?
This was my interest. I was interested, Edward, how, you're best known as an actor.
Yeah.
Like, what got you interested in a software startup focused on board governance?
Well, it's a fair question. You guys know, because I've talked with Yahoo about it. I started a media analytics company called EDO that's become a major measurement partner of the streaming services and all of the networks and the buy-side marketers. We sit in the outcomes and performance measurement space. And I had started a company that did crowdfunding for charities called CrowdRise that merged with GoFundMe many years ago. And across these experiences, I ended up sitting on corporate boards. I started companies that had boards with venture capitalists on them, and then I ended up sitting on boards like GoFundMe's board, and I've sat on nonprofit boards for 30 years. My theater company, my housing finance organization I love, and conservation organizations, and I've literally lived within these dynamics, and I've seen really positive relationships between management and boards, and I've seen completely terrible, toxic ones, and I think my partners and I really felt like this is a ubiquitous pain point. This is a big elephant in the room that everybody knows is a big problem and nobody is dealing with. And so we tried to envision, like, what would this look like if it was working? And Zeck already, I have to say, like, for something that sounds as boring and esoteric as board management software, we are getting responses to it that are actually emotional. Like, the level of gratitude we're getting for sort of building a better mousetrap for helping this process. And actually from both sides of the table, we've had capital management groups and CEOs saying, this has radically improved, not just the quantitative amount of time we waste getting ready for this or in the meeting itself, but it's actually changing the qualitative aspects of the relationship and making the meetings much more forward-looking as opposed to, reading through what's happened in the last 6 months.
It's interesting because the cynic in me thinks like maybe some of the friction was by design in some cases, right? I think more of the sort of shareholder company relationship and shareholder meetings and that is still a very antiquated system.
Yes, it could be, and I won't try to reform that one, but
not yet.
No, but if you think about it, like, yes, there's a governance function, especially for very large companies, but fundamentally, I think companies should be able to expect a reciprocal obligation with their board. Boards are there to serve the company, and think about how insane it is that in 2024, that I would send to you a platform of information and documents and things you're supposed to digest, and I can't even see. I have no access to data on how much my own board has interacted with what I've sent out. Zeck lets management see precisely how many minutes every single individual board member spent in every section. They can be queried by that board member with questions and refinements, either privately or within the group. You can do governance functions like vote. On average in board meetings, nearly an hour is spent on governance functions like employee stock option approvals and minutes approvals. Do you know how, these are high quality people with a lot of better use of their time than voting aye around a table. You should be able to do that from the airport terminal, which is, by the way, we find 80% of most board materials are read on mobile. And yet no one's formatted it for that. You wouldn't read Axios or the New York Times or Yahoo on a PDF that you have to pinch scroll into. You read it in a mobile format. And if 80% of your board members are reading the stuff you send them on phones and on tablets, obviously it should be formatted for that. And obviously, I think these things are intuitively obvious when you say them, but no one had done it. So we just decided we're going to fix this.
I'm interested because, there's a lot of successful actors who now have, lack of a better word, kind of a side hustle, but one that, obviously you're passionate about this, right? But you see it with, it's Ryan Reynolds and Ashton Kutcher. It's not a new trend, but is it more of a do you think it's more of a pronounced one now? And what would be the reasons?
I can't really speak to that. The stuff you're talking about I would categorize more as investing. Investing and aligning or making partnership deals. I've done some investing, but I've sort of, I worked in kind of an esoteric corner of finance when I got out of college in affordable housing tax credit finance, and I've always been interested in in starting organizations, whether it's theater companies or companies. And some of it is just that I like, the famous doctor and pioneer in global health, Paul Farmer, was a friend of mine, and he used to say the most fun thing in the world is solving hard problems with friends. And I agree with that. And I think envisioning a problem that needs to be solved and coming up with either a service or a solution, it's not as divergent from telling stories in films as you would think. It is at the beginning anyway, it's a very creative experience. And it is, a lot of what we're doing right now is we're storytelling. We're talking about why would someone else have empathy with this problem, or you're actually trying to show people you've got empathy with the problem they've got, and that draws them into what you're doing. And so for me, it's not as hardcore a left brain, right brain dichotomy as it might seem. But I can't explain it. It's I never got into the arts because I wanted it to be a 9-to-5 day job. To me, that ebbs and flows with inspiration and opportunity, and it leaves a lot of space for me to do other things I'm interested in, like this. But it's funny. Like, I've known Mark Benioff, who founded Salesforce, the great cloud computing software company, and I've always really liked Mark. He has an ethos of he has a corporate ethos that I really admire. He talks a lot about stakeholder capitalism as opposed to just shareholder capitalism, where you look at your environment, your employees, your community equally with share price and I admire that. And I never bothered Mark about this, but we did cultivate a relationship with Salesforce's venture team because we felt more than any just pure investor, we really liked the idea of working with the kingpins of value-added cloud-based software. And our DNA, the fact that they've made this vote of confidence in us and given us just some capital to scale with and stuff is pretty thrilling to us, because we really feel in alignment with them, both in terms of they have a better understanding of the business, these kinds of businesses, but they also have cultivated, I think, what I would call they have a more humanistic view even of the way corporations are supposed to function, and we are actually trying to promote better relationships between managements and their boards and vice versa. And so we're pretty excited to work with them on this. It was great that they stepped up to this.
Mark Benioff and Salesforce, not the ventures, but overall, is also well known as being very acquisitive. Do you have an end game for Zeck where you would sell it to a company like Salesforce, or?
It's premature in a way. I mean, I think we're literally just getting going. We have, it's been a real rocket ship. We've had, just by talking about this problem, not even talking about our product, talking about the problem of why board dynamics are toxic, we've been invited into lots of forums, from YPO to Tech All-Stars, Tiger 20. We've gone, and the response has just been absolutely off the charts. People are really frustrated by this problem, and I think it was affirming to us. And we had hundreds of nonprofits and thousands of companies sign up for this really quickly, and and that's exciting. Right now, we're just trying to get more people aware of it and stuff like that. I think we're a long way from that phase. Yeah. I think, but I don't. It's funny. Like, some people, when we built CrowdRise, which was a really great social fundraising site for nonprofit organizations, and GoFundMe was doing the same thing, except I'm helping my friend whose house burned down. Some people were telling us, go it alone. It'd be your own thing, and I don't know. I have a little bit of I think John D. Rockefeller was right in some ways about the power of the combination, he used to call it, with Standard Oil. And I think sometimes, we live in this world that's informed by Elon Musk and Mark Zuckerberg and these kind of titans, and this whole generation of entrepreneurs is unicorn or bust, or I'm going to go thing. And I don't think that's very mature. I think there are a lot of businesses that benefit enormously at some point from rolling into some sort of a conglomerate structure, and they have made a great product, but they may not be literally a sector unto themselves. And I think, you know, there's a lot of people who probably wish they'd sold their companies earlier than they did right before we went through some gigantic down cycle where valuations dropped off and capital dried up. You know what I mean? So I think one benefit of being the age I'm at and having done other things in my life is you don't necessarily hitch your ego to the idea of some infinite outcome or maximalization. And I think, to your point, sometimes you really got to look at it and say, is what we're doing really successful but niche? You know, and so we should align. Or have you built something that's standalone? I mean, GoFundMe is a phenomenal organization. It's one of the most interesting companies I've ever been involved with. It's providing this huge social service, which is moving between $4 and $5 billion a year in very small increments to charitable purpose without taking any deduction away from it.
Right.
And it's not a hyper-growth company, perhaps, but it's an incredibly great self-sustaining company that's filling a real service. And I think
So if you can achieve that,
yeah, exactly.
then you've done it, yeah.
So they, you know, I don't think you can ever say like one size fits all with things. And I think you just sort of have to feel it out as you go. But right now, what I can say that we're excited about is, like I said, it's actually kind of wild to get kind of a certain amount of emotion and gratitude back. Like, you know, you think software sounds very clinical, but I do think we're taking something that was none of us set off to say like, my aspiration is I'm going to be a great builder of board deck slides. You know what I mean?
But
And if you can liberate
yeah.
people from the part of their day or their week or their month that's pretty onerous, I think that's nice.
Yeah. Edward Norton,
Yeah.
thanks so much for coming in.
Absolutely, thanks for having me.
Appreciate it. Up next, the energy sector tumbling in today's trade. More on the smart way to play the sector on market domination. That's next. Energy stocks underperforming the broader market in today's session, though it does remain one of the year's best performing sectors. We're looking at how to navigate the big picture with the Yahoo Finance Playbook. To discuss, we're joined by Stuart Glickman, Synergy Equity Analyst and Deputy Research Director at CFR Energy Analyst, alongside Sarah Hunt, Chief Market Strategist and Portfolio Manager at Alpine Saxon Woods. Stuart, we're going to start with you here and just kind of get straight to what might be some of the winners as we look at an energy sector that's already had a pretty decent run this year.
Right, Julie. So thanks for having me. So I think if you're going to think about where to play energy, you have to start first and foremost with what is your outlook for crude oil prices, because 7 out of every 10 barrels of oil equivalent are coming from the liquid side of the ledger. And crude last year averaged $78 a barrel. That's for West Texas Intermediate, the U.S. benchmark. We think this year, probably somewhere in the neighborhood of 80 to 90 will be the average for the year. And in that kind of environment, I think you want to be positioned with upstream, the folks that benefit directly from the price of the barrel of oil when they sell it. Start with the biggest name in the business, ExxonMobil. We have a 4 stars or buy opinion on Exxon. They have relatively stronger exposure to crude oil than their chief rival, Chevron. A lot of growth potential coming out of Exxon in the next couple of years, particularly from Guyana. Awful lot of growth potential offshore there. So we like Exxon. Their balance sheet is in incredible shape. Plus, you're going to get, the dividend. Plus, you're going to get benefit from buybacks.
Sarah, same question to you. We're talking about the energy sector, big sector, obviously, a lot of subsectors there, verticals to think about, but kind of big. Give me your 30,000-foot view, Sarah. Looking ahead here, bullish on the sector generally?
Bullish on the sector generally. I would say that one of the issues has been you're coming out of the pandemic. Demand just dropped off the face of a cliff. Supply stayed pretty okay. We're starting to see some of those dynamics change, and I think you're starting to absorb a lot of that supply. So I think from a longer term perspective, we like it. We think there's a much longer tail on hydrocarbons than people expect there to be, even though there is an energy transition underway.
And the big guys are getting bigger, Sarah, in many cases, right? We've seen acquisitions happening, Exxon Pioneer, Chevron trying to acquire Hess. We'll see how that ends up working out. Is there going to be strength in size when it comes to E&P?
I think there's absolutely strength in size. And you've also seen consolidation on the service sector. So when your suppliers are consolidating and you consolidate, then you can meet each other in a more equal way. But there's been an enormous amount of consolidation in the energy patch. I've been around for quite a while in that group, and the number of companies left is a lot smaller than it was if you looked at it 5 or 10 years ago.
And Stuart, kind of similar theme I want to get your take on. Obviously we talk about the energy sector here, a lot of M&A, Stuart. I'm interested whether you see that activity continuing, and if so, any potential takeout targets in your coverage universe, Stuart?
Right, Josh. So you're right. M&A has been really prolific this year. The common theme to a lot of the mergers, but not all of them, has been exposure to the Permian Basin. And where you're seeing in particular is companies that are buying up acreage that's adjacent to their own. Exxon and Pioneer, for example, that's a fair piece of, I think, the value of why Exxon went after Pioneer. When you buy up the adjacent acreage, now you can run longer laterals and reduce your unit costs when you're doing that unconventional shale development like Exxon does. I do think this is likely to persist. And I think Sarah's point that, the recovery on the demand side is really, I think, in full swing. And this industry has really kind of underinvested in new supply for the better part of the last 7 or 8 years. And that's going to come home to roost. We're just simply not going to have enough supply, probably through the end of this decade. I think that keeps prices elevated.
And Sarah, I want to touch on the other big theme here. You mentioned hydrocarbons have a longer tail than people thought. But most of these companies are also investing in sort of carbon capture technologies, looking towards a post-hydrocarbon or a less hydrocarbon world. Is that, though, when you're investing in these companies, is that part of your thesis? Is that something you're looking for, or are you still focusing on what's happening now?
I would say that it has to be an and, because there is going to be a transition. And so you want the companies that are taking it seriously and spending money doing it. You don't want them indiscriminately throwing money away, but you want to look at companies who are trying to figure out how to position themselves and or how to make things cleaner, faster, better than they were, because that's obviously an issue for the entire industry. So it's definitely a piece of that. And then you look at some of the transition fuels like LNG, and you look at some of the companies that play into that area as well. I think you're going to see that's going to become important, even more important as well, as that really starts to become globalized. It's still a bit landlocked in different places.
And we got Stuart to talk about some of his names. What are some of your preferred names in the industry?
Well, we like some of the service names too. So Tidewater, there's been a huge consolidation in the boats that service all of the offshore oil rigs and all of the general offshore production. We also like Schlumberger, and we like ConocoPhillips, and even though Exxon has done better than Chevron, we like Chevron as well.
Do you think that the Hess deal will get done?
It's always a question with M&A, and I think it's a big question right now with the FTC, because they keep asking for more information, even in areas where that didn't used to be so much of an issue. So they're very confident. Hess is confident. Chevron's confident. Can anything happen? Absolutely. So you don't want to absolutely count on that for the only thing that's going on. But I think that it's just a very different industry than you used to have. Return on invested capital is important. Dividends are important. They don't stretch their balance sheets the way they used to. It's a much different industry.
All right, thanks to you both so much. Really interesting stuff. Sarah and Stuart, thank you both for joining us. All right, it's almost time for the closing bell, so let's get it over to Jared Blickery. He's going to help get us up to speed on the action, sponsored by Tasty Trade, and we're about 30 seconds from the bell. Jared, what are we seeing here?
Inauspicious close to the month. It's all red in the sector action. Let me show you what's happened in these 21 trading days of April. Not looking a lot better. In fact, a lot worse. Real estate, the worst off, down almost 7%. Tech, another loser, down 6%. And then communication services off 5%. Only thing in the green here is utilities. Also note that Staples basically unchanged. So very defensive setup to this month. And I want to show you something else here. I'm writing in the morning brief about some of the changes that we've seen over this month. Now, as it happens, and there's the closing bell on Wall Street, January through March, we saw the 3 biggest gainers in market cap. That would be NVIDIA, Microsoft, and Meta. You can see up there, NVIDIA gaining $1 trillion in market cap. Well, they were also the 3 biggest losers in April. So I thought that was pretty interesting. NVIDIA lost $65 billion out of $1 trillion. That's not really a lot, but Microsoft gave back $136 billion and Meta about $140 billion. So you put it all together in terms of some of the sectors, not surprisingly, tech saw the biggest gains through March, and that was $1.5 trillion, and also the biggest losses in April. That was down $450 billion. Then you have communication services. That's the home of Alphabet and Meta. That was up $647 billion, almost $650 billion in March, through March, and then $222 billion was lost in April. Excuse me a second. And then if we go back to our heat map here, I just want to show you what's happening with some of the leaders. Only 2 of my leaders in the green here. This would be Cannabis and also Chinese stocks. So Chinese stocks operate on their own fundamentals. Cannabis stocks very dicey at times, usually in the leadership position or the laggardship position, dead first, dead last. But this month, dead last is Bitcoin. Bitcoin down about 15%. And then you have unprofitable tech as expressed by the ARK Innovation Fund. That's down 12%. Then you have solar stocks. Then you have IPOs. So it was really a risk-off month, not only in terms of some of the fringier laggards, but also in some of the growth stocks. So let me just show you what happened with our meme stocks. And you can see just tons of red on this page, not a whole lot of green. And then I think finally what really encapsulates this is the Nasdaq 100 itself. And there are some outliers here. Alphabet was, it just clocked in $197 billion in one day last week when it reported earnings. And that was basically its entire gain for the month, but it's still up about 5%. Apple also clawed back some losses. So let me just show you what's happening with year to date on Apple. Looks like its losses finally slowing down. We'll get those earnings on Thursday. And then if I sort by equal weight, you can really see that just a lot more losers than winners. And for what it's worth, AstraZeneca in the top spot there, it was up 13%. Keurig Dr. Pepper, that's up 8%. Pinduoduo, one of those Chinese stocks, up 5%. But the biggest loser here, that was Intel. Intel down 31% and 39% year to date. Guys?
Thanks so much, Jared. We've got Amazon's numbers right now, so let me bring them right to you. And I want to actually jump to the forecast here. The company's second quarter net sales forecast at $144 to $149 billion. That's slightly short of the $150.2 billion that was estimated by analysts. So the stock was bouncing around in the after hours initially. We'll see where it lands, but right now it is higher. Let's talk about the first quarter here. Our earnings per share at 98 cents. That looks to be 15 cents above what analysts had been anticipating here. Net sales of $143.3 billion above the $142.6 billion that was estimated by analysts. And then running through some of the individual lines of business, AWS, Amazon Web Services net sales, excluding the effects of currency, up 17%. That is better than had been estimated. Net sales for AWS at $25.04 billion. So overall, it looks like last quarter was better than estimated on a number of different metrics here. The company also pointing out that the growth rate for AWS is now at $100 billion annual revenue run rate, as AWS has been pretty dominant in cloud here. Also seeing now a forecast for second quarter operating income, the midpoint of which is $12 billion, which is a little bit shy of analyst estimates. So that's what I'm seeing so far here. Going to keep looking through the statement, et cetera. What stands out to you, Josh?
Yeah, a couple of things. One is that Q1 operating margins, easy beat, 10.7%, and the street was closer to 7.6%. There, and also you're right to call it AWS, the cloud computing business. That is this company's profit engine. That's why we make a beeline for it. XFX 17%. Street was closer to 14.5%. Maybe not totally surprising, Julie, because we heard from the other hyperscalers, the other cloud giants like Microsoft, like Google, and they turned in very strong growth as well. But that's giving investors a lot of confidence here, and you can see the pop, at least initially, in the after hours.
Yeah, most definitely here. And, it's interesting to see the stock doing as well as it's doing, because in other situations where we have had the guidance disappoint, the stock has been punished. Our own Alexander Canal's here with us on set here. And I know you're looking at these numbers closely, especially what's happening with Prime Video, for example, since that's part of your streaming purview. But, what stands out to you from the numbers thus far?
I definitely agree with Josh that AWS, this was a focus that a lot of analysts were looking at, and they said that in order for this stock to accelerate, AWS would have to see material growth, and it looks like that happened. I am a bit surprised that we didn't see any type of dividend or stock buyback. That seems to be the story among all of these tech giants. We saw that from Meta last quarter. Google recently did its own dividend and buyback. But, this is really the AI story. And I think on the earnings call, if there's any type of caution among AI, that could potentially drag down the stock. But Amazon is one of those companies that has been doing well. I agree, Julie. I am a bit surprised that because the guidance came in a bit short of estimates, that's not having more of an impact on the stock. But we'll see how we continue through after hours.
Yes, we will. And just looking in the statement now and some of the commentary that we're getting from CEO Andy Jassy here, who points out that it's a good start to the year. He's the one who pointed out the $100 billion annual revenue run rate for AWS specifically. Talked about advertising efforts continuing to benefit from the growth of their stores and Prime Video business, but he points out it's early days for some of those businesses. I was looking for some more sort of specific numbers around advertising, et cetera. Not necessarily seeing all of that yet. So it's interesting. There's a lot of color on the various businesses, but not as much in terms of those specific numbers here. So the call will be interesting to see if we can get some more of that color and more specific numbers on all of this. I'm still going. It's a long statement, so we're going to continue to pour through here. But in the meantime, we're also going to get some reaction right now from Arun Sundaram, who's CFRA Research Senior Equity Research Analyst. Arun, thank you so much for being here. So we've been sort of puzzling over why the stock isn't being punished more for this guidance that appears to be short of estimates. What's your best guess here?
Hey, yeah, thanks for having me. Yeah, so the guidance was a little bit softer than we expected, but I think what was offsetting the weaker guidance is really on the AWS line. We saw 17% AWS growth this quarter. That's a 4-point acceleration from Q4 of 2023. Consensus was around 15%. So this was a really strong beat on the AWS line, and probably more importantly, AWS operating margins this quarter was at 37%. That's the highest going back several years. So not only is AWS revenue growth reaccelerating, we're also seeing really strong profit margins in that business, and I think that's really the highlight this quarter.
Arun, when you look at these North American retail margins, do you see retail profitability Arun, just continuing to improve from here? Just the way they maybe integrate AI and robotics, bring down costs.
Yeah, so that's been the big story for Amazon for the last several quarters now. It's all the efficiencies that they're generating in their e-commerce business, not only in North America but also internationally. You have to remember, Amazon is still relatively young in many markets around the world, and it takes several years to become profitable in certain markets. It took about 10 years to become profitable in the U.S. They just recently became profitable in Mexico. It took about 8 years to become profitable in Mexico. So it's encouraging to see North America retail margins continue to improve. It's also encouraging to see international profits improve. In fact, the international segment this quarter actually posted a positive operating profit of $900 million. That's the first positive operating profit in the international segment going back till the early days of the pandemic. So that's encouraging to see as well. And lastly, like I said before, the AWS, those margins were really strong this quarter. So it was really on the profit line, I think, is why the stock is up so much right now.
Arun, there is one piece of news we didn't get from Amazon, and that's any announcement of a dividend. That's something some investors have been watching for. We got Meta, then we got Alphabet. Is it disappointing to you that we didn't get that Amazon dividend?
Yeah, so there was a lot of speculation that maybe Amazon would announce a dividend after some of the other big tech players did. We weren't expecting a dividend announcement this quarter. We could potentially see one maybe in the next year or two, but I don't think it really matters to investors at this point. And I say that because profit margins continue to strengthen for Amazon, and the free cash flow story is also improving for Amazon. And I think investors would like to see Amazon, reinvest in its business. We know CapEx is going to be up this year. We're actually forecasting about 13 to 15% increase in CapEx. That likely could be even higher given all the opportunities in generative AI. But yeah, I think over the next year or two, we could potentially see a dividend. The free cash flow is becoming a lot more attractive for Amazon. It has been improving over the last few years. In fact, going 2 years ago, they were free cash flow negative. And now this year, we're forecasting about $70 billion in free cash flow for Amazon. So yeah, we do think we could potentially see a dividend. It's probably not going to happen, in the next quarter or two.
And Arun, what about Amazon's AI strategy? I'm interested to get your take on what their competitive advantages are in that area.
Yeah, so there's a lot of speculation whether is Amazon losing market share to Google and Microsoft in the AI race. I think it's really hard to tell. I think because one, Amazon has the largest cloud computing business. AWS is by far the market share leader, and so just given that you can't just look off of growth rates and determine really market share gains or losses. I think Amazon has a very compelling stack of generative AI products and services. They manufacture and sell chips, which many people don't maybe even know about. They have large language models through Amazon Bedrock, really compelling large language models, some of which are not Amazon-owned large language models. They're actually partnering with third-party firms, including Meta, for example. Anthropic is another example of an investment. And they also have various generative AI applications and services. Just today, they announced that their Amazon Q, which is essentially a chatbot for developers and coders, is broadly available. And so I think Amazon is a very compelling generative AI story, and we're seeing it being starting to be reflected in the numbers even today.
Thanks so much, Arun. Appreciate it. We got to turn to some other earnings that we're watching right now as well, and that includes Starbucks. Now, Starbucks disappointing here, both on the bottom and on the top line. This is the fiscal second quarter for Starbucks that is just reported. Adjusted earnings per share at 68 cents, 12 cents shy of analyst estimates, and second quarter comparable sales down 4%. Analysts had been looking for a gain of 1.5%. And looking through the different regions here, it looks like it was disappointing across the board, but particularly so in China. Comp sales in China for Starbucks down 11% versus the 1.6% drop that analysts on average were predicting. International overall down 6%, North America down 3%, and US down 3%. So really quite surprising numbers from Starbucks.
Yeah, I mean, the stock is really sinking here in the after hours, and for good reason, Julie, because you just noted, I mean, there's just misses all over this print. I think, listen, some questions about inflation, price increases. China really stands out. I'm seeing Q2 China comp sales down 11%. That really misses what the street was looking for there. So what is going on there? Is that the shaky economy? Is that the home team maybe taking a bite here in terms of competitive pressure? That'll be a big focus on the call. Also, I mean, you want to hear more about California boosting the minimum wage for fast food workers. I think they were to 20 an hour. So lots of misses all over this print, which I think explains at least the initial reaction here after hours.
Yes, exactly. And, you know, if you're looking for what happened here in the quarter, you will not find it. Well, actually, I was looking at the release, but it was the last quarter's release. So I was trying to look for some commentary here on what might have happened, but not seeing it. But it is notable, I think, that you are seeing a pullback, not just in one market for Starbucks, but really across the board. So I'm really curious, to your point, what's that about? Is it that people are trying to save money and that they're not going to Starbucks, whether it be in China or in the United States? So obviously we'll dig into that a little bit, but it is unusual to see this kind of a disappointment from Starbucks. I'm just doing a quick look here to see what their history has looked like. It looks like this could potentially be the biggest drop since a 9% drop in reaction to their second quarter numbers in 2023. But we'll keep digging in here and see what exactly is going on. On the flip side, we've got quite a different story with Pinterest. Those shares are soaring in the wake of their earnings. In fact, up at first blush, something like 20% here, 19% or so right now. Those earnings per share in the first quarter beating by 6 cents a share. Revenue of $740 million is $40 million above what analysts had been anticipating. This is an interesting average revenue per user at $1.46, which is 7 cents better than estimated. So that's a good metric for them as well. Oh, and I'm also seeing a second quarter forecast for revenue. That it might be a little, no, that's ahead of estimates too. 835 to 850. Yes, I know what numbers are. 835 to 850 million is what the company expects in the second quarter for revenue. 828 million.
You know, last time when they reported, Julie, you know, they had that miss on the top line, and I wonder how much, you know, expectations did get reset. But I think, you know, you look at the earnings now we've gotten this season, so at Meta and Google and Snap and now Pinterest, it does paint this picture of what looks to be just overall strength in the kind of the broader ad environment, ad market. It's certainly looking better than a year ago. I know on the call there's going to be questions, Pinterest specifically about the Amazon Google partnerships. I know they had the ad tools improvement, but at least initially here, stock is roaring on those results.
Yes, there's a lot going on, and there's more to come. We're still waiting for AMD. All right.
Right now? Did that come out?
We'll do it next. We're doing it a little bit. We're doing it a little bit.
We're just getting started here on Market Domination. There we go, overtime. More earnings results after this break.
Sorry.
Let's get you up to speed on the action from today's trade, sponsored by Tasty Trade. Got red on the screen today. All three major averages ending the day lower. The Dow down about 1.5%. The S&P 500, your broad gauge, down about 1.6%. Tech-heavy Nasdaq down about 2%. Couple different dynamics. Inflation data today, gauge of labor costs. We know that's watched by the Fed. Did increase the most in a year, adding to that theme of sticky U.S. inflation. We also saw that drop in consumer confidence as well. Of course, we're waiting now for the Fed, the expectation that central bankers will keep those rates unchanged tomorrow. Investors don't believe they're likely to cut anytime soon. And now, of course, a lot of earnings, Julie, to think through as well.
And here's another one. We're watching shares of Advanced Micro Devices, AMD, in after-hours trading. Those shares pulling back by about 3.6%. Let's run through the big numbers here. First quarter earnings per share, 62 cents. That's a penny ahead of estimates. Revenue at $5.5 billion versus the about $5.45 billion that was estimated. So I think we can call the first quarter earnings and revenue roughly in line, slightly better than estimated here. Operating margin at 21% versus 20.8% estimated. And then there's a second quarter revenue forecast. The company says second quarter revenue will come in at $5.4 to $6 billion. Analysts had been looking for $5.72 billion. So midpoint of that may be a little bit shy of what had been anticipated. And the company says second quarter adjusted gross margin will be about 53%, which is in line with estimates. Now, I guess in this environment, maybe in line with estimates is not quite enough.
Well, it's interesting that the stock was down about 10% in the past month heading into this print. Julie, it's funny when you think about AMD, you almost kind of think of it like two prints almost, because you have like the core AMD business, and Lisa Su is going to get all kinds of questions on the call about the PC market and where she sees it heads from here and what are the potential drivers. Same question for sort of that non-AI traditional data center business as well, gaming. And then, of course, though, the attention, and maybe the most attention, is on this company's AI story, questions about orders and margins, and any updates, by the way, about AI processors, revenues in 24, what they look like, versus that prior call Lisa Su gave us for around $3.5 billion.
So looking at the statement now, I just want to mention a couple things on that front. Lisa Su, as you said, the CEO, saying in the statement that there was 80% year-over-year growth in the data center and client segments, and that it was driven by shipments of their MI300 AI accelerator and adoption of some of their new processors. So interesting there that she's talking about those big gains. Record data center segment revenue was $2.3 billion, up 80%, as I mentioned. So seeing those gains. So it's interesting. I mean, maybe they've managed expectations too well when it comes to that second quarter forecast. Perhaps the market had been used to some of these big, 80% is a big gain.
Yeah. Tremendous.
But maybe the market has had, even with the pullback that we've seen in the stock, maybe it's priced in some of these gains in the business.
Yeah, there is excitement about AMD's, and you mentioned it, Julie, spot on, the MI300 series. There is excitement about their AI play, but you're going head to head with NVIDIA, and of course, Jensen Huang isn't standing still either. I mean, they're busy prepping new product ramps. So, kind of, what does that all mean for the competitive landscape? That's another thing to listen for on the call.
Yes, a lot to look forward to still. Well, in the meantime, as we look back on the day, economic data spooking investors on Wall Street ahead of the Fed decision tomorrow. Alexandra Canal here with some trading takeaways from the day.
Well, it wasn't a great day by any means for stocks. It was the worst month of the year for April, and what a way to go out. We had the Nasdaq down 2%, the S&P 500 down 1.6%, the Dow sinking 1.5%, and then you had yields surging with the 10-year Treasury jumping about 7 basis points to trade near 4.69%. And we really saw this sell-off escalate throughout the trading day. It started earlier this morning after we got hot labor market data, which signaled the Fed's higher for longer narrative is largely here to stay. This data, the employment cost index, which measures wages and benefits, that increased 1.2% from December to March. That was the highest increase in a year after rising 0.9% at the end of 2023. So this shows us that we're not just dealing with sticky inflation, we're also dealing with sticky wages, and that could become a big pain point for the Federal Reserve as it looks to eventually cut interest rates down the line. It certainly seems like the higher for longer narrative is here to stay. And along with that, we also saw consumer confidence further decline. That's been on a steady decline over the past few months now. Confidence dipping to its lowest level in more than a year and a half during the past month. The Conference Board saying that consumers have become more pessimistic when it comes to the future of business conditions, job availability, and income. The Conference Board also said that elevated prices for food and gas, which we have continued to see through that CPI print, that's also weighing on consumer concerns. So a lot of mixed data that we've received over the past several months here. And the overarching takeaway is that the Fed really needs to take its time now. And I'm sure when we hear from Jerome Powell on Wednesday, he's going to reiterate that rhetoric that the data needs to tell us what to do. And right now, everything's sort of all over the place. If anything, it's telling us that inflation is very, very sticky.
Yeah. I wonder if, do you think Jay Powell kind of puts a hike back on the table? Think it's time for that?
No.
No.
But
Okay.
That has been a rumor.
Just like that.
No, absolutely not. But who knows?
Who knows? We'll see.
You know, we did have, of course, also the sort of dip in confidence. It was also a big part of what we were watching in today's session. As you know, we heard a bunch of companies saying that it doesn't sound like they're certainly not lowering prices, even if they're not raising prices at the same rate.
Yeah, so as these earnings reports have trickled in, we're seeing certain themes emerge, and one being related to that inflation story and that prices are continuing to go up, and a lot of these companies are passing on those costs to consumers. We saw that with quite a few companies. Pepsi earnings last week, Coca-Cola earnings this morning, and then McDonald's. McDonald's highlighting strategic menu price increases in the U.S., with the CEO saying on the call that consumers continue to be even more discriminating with every dollar that they spend as they face elevated prices in their day-to-day spending. So that's one of the reasons why we saw same-store sales miss estimates at McDonald's. That's not something we often see. This has consistently been a pretty strong company over the past few quarters, but we're now seeing this macro narrative play out for a lot of these companies and showing up in their earnings results. So something to continue to keep in mind as earnings season rolls on.
All right, Allie, thank you so much. Appreciate it. Moving on, the Federal Reserve may be under more pressure to keep rates higher for longer as labor cost data for the first quarter show no signs of weakness in the labor market. The news setting the yield on the 2-year above 5%. And joining us now is Kevin Flanagan, Wisdom Tree Head of Fixed Income. Kevin, it is good to see you. So I was talking to Julie, Kevin. I don't know if you heard that. I thought, hey, maybe Jay Powell. I look at ECI today, Kevin. I look at home prices. Maybe Jay Powell thinks it's time to put a hike back on the table. What do you think?
No, I'm going to go with your segment right before me. Nah, I don't think we're going to get that yet, but I do think he's going to reiterate their disappointment in the lack of progress on the inflation side, and higher for longer is where we're at. I couldn't agree more.
So higher for longer is where we're at. So what do you do as an investor then in this market? What are the implications of higher for longer, especially if it's higher for longer with, sort of lousy consumer confidence readings and maybe some more rocky economic data?
Well, we like to call it kind of like the new old rate regime, where rates have gone back to where we were prior to zero interest rates, negative interest rates, quantitative easing. So I think you have to look at it from the more traditional role for fixed income. And one of the ways to focus on it is to still inverted yield curve. So we like Treasury floating rate notes as one end of, say, a barbell strategy, and then looking at something that's more of a core benchmark type of weight on the other end, and try to toggle back and forth, because I think we are getting to the point where you do want to leg in a little bit, maybe lock in some of those yields a little bit further out on the curve. And when I say further out on the yield curve, I don't mean long duration. I'm talking about, getting into that 3, 4, 5 year kind of area.
I'm interested, Kevin, though, you see, evidence here the economy is slowing. We were pointing out the latest inflation indicators we're getting. People are discussing stagflation as a possibility. Do you see that, Kevin?
No, I can't say I'm that old that I actually was in the business for stagflation, but I do remember studying about it. And I think, the inflation part, I wouldn't necessarily argue with, but it's the stag part. If you look at the GDP numbers we got last week, on the surface, they looked softer than expected, but underneath, if you looked at real final sales, which is the underpinning of the economy, consumer spending, business investment, residential outlays, 3 quarters in a row now, that's been above 3%. So I would not be in that camp at this stage of the game.
Do you think we're going to end up seeing 5% on the 10-year?
Haha, Julie, great question. Yeah, I think there's a shot we make another run at it at this stage of the game. I don't know if it would be sustainable, much like we saw last October. What I find interesting, though, is that fourth quarter rally in Treasuries, you all were mentioning it just a few minutes ago, we've retraced about 75% of that. And I think you're getting to the point now where the market is better priced for a Fed being on hold for a longer than expected period of time.
And Kevin, for those fixed income investors who are listening right now, you did a good job outlining where you see opportunity. Where would you avoid, Kevin?
Well, I wouldn't necessarily go too far out in duration. You're just not getting compensated to do that. And we've seen a lot of elevated volatility in the bond market. So if I can get income without the volatility, that's where I would focus on. And that's why we like Treasury floating rate notes as one of our high conviction ideas. Kevin, great to have you on the show. Thanks as always for joining us. Appreciate it. Thank you. Time now for What to Watch Wednesday, May 1st, starting off with the Fed. The FOMC interest rate decision is coming out tomorrow. Fed Chair Jerome Powell giving a press conference after that around 2:30 p.m. Eastern. Central Bank started its meeting earlier today. Wall Street not expecting any rate cuts for May. Yahoo Finance's live coverage of Fed Day starts just before 2 p.m. Eastern.
And earnings season continues, of course. Tomorrow we'll see reporting from MasterCard, Qualcomm, and Pfizer, among others. Qualcomm announcing second quarter earnings for 2024 after the bell, and analysts expect the tech giant's results will be in line with its conservative guidance for the quarter. They'll also be looking to see if phone sales will stabilize in China amid mounting competition from Huawei and weaker than expected iPhone sales.
And more on the earnings front, we'll see more reporting tomorrow, including Pfizer, Kraft Heinz, and eBay. Pfizer announcing first quarter results before the bell. Expectations for the pharmaceutical company are low. Stock is down almost 35% over the past year. Analysts expecting growth prospects to be gradual and contingent on operational outperformance.
Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. And stay tuned, we've got more Yahoo Finance on the other side, including an interview with the CEO of Mondelez International.
Mondelez out with better than expected earnings on the back of all things snacks and, well, maybe some higher prices for those snacks. Let's welcome in Mondelez Chairman and CEO Dirk Van de Put. Dirk, always nice to get some time with you, especially on a busy earnings day. You know, there's been some talk, I think, in the food industry of a snack session or demand for snacks slowing down. Have you seen any of that?
No, I would say that consumers still want to snack. The volumes of our category this quarter were flat, so they're not exactly snacking more, but they're certainly not snacking less. What we see is that the penetration of the category is still very good. Frequency is a little bit off amongst the lower income consumer, and we also see sometimes the volume that they buy a little bit off. So we can detect that there is a group of consumers, particularly the lower income consumers in the US, that are being affected by everything they see, interest rates and the SNAP benefits that went away and so on. But snacking less? No, not yet.
Well, that's a good thing, I'm sure, for a company like Mondelez. So in terms of, you think that consumer, that low-income consumer that you mentioned, Dirk, they're pulling back because of higher prices. You know, we've followed a lot of earnings so far. Coca-Cola, we've, of course, seen your report. Even a company like Molson Coors. A lot of these companies have pushed through higher prices, and it's continuing. Where do you see it from your vantage point?
Yeah, no, we have the same going on for us in the sense that the inflation in our input cost didn't ease this year. It's right up there where it was last year, so another significant increase in our cost, and we have to reflect that in our prices. So it's not that we particularly want to increase our prices. We would prefer not to, as you can imagine, but the inflationary environment is not easing at all. And so I think the consumer sees the prices, the interest rates, the job market isn't great. Like I said, the SNAP benefits disappear. So they're being hit from many different angles, and it's clearly noticeable that it is affecting them.
How serious an issue is it? We've covered a lot here at Yahoo Finance, the rise in cocoa prices. Is that the type of inflation that your business continues to see, where you have to push through even more price increases this year?
Yes. So we have people wonder all the time, why is inflation not going down? Because we've already had big run-ups in transportation costs, or we had it in oils and things like that, but it keeps on changing. So this year it's in cocoa, it's in sugar, and it's in labor. And those three combined give another year of input costs that are increasing. And particularly cocoa, as you probably have seen, has gone to heights that we've never seen before. I assume that over time that will come down, but nevertheless, it probably won't come down to where it was, and that will lead to increased prices for chocolate.
One of your biggest customers, Walmart, is making some news, releasing a whole new line of products. Actually, it's pretty significant. One of the major food reinventions for Walmart in the past 20 years. Dirk, do you view their new brands as a new competitor, whereby you go back to your innovation team and you say, wow, we need to take our innovation to the next level, or these products don't really compete with you guys?
Well, we're lucky in the sense that we have very strong brands, quite iconic brands with, for instance, Oreo. We're in categories where private label or own brands are not so present, particularly in chocolate, but also less so than other categories in biscuits. So the combination of our strong brands and the fact that the consumer really likes the taste and whatever that brand represents for them protects us from these situations. And so we probably look at our innovation and we try to keep on surprising the consumer with new things. But I wouldn't say that at this stage this is a major concern for us.
On the full year outlook, it looks like you're keeping the organic sales outlook unchanged. Is that related to the caution you're seeing among some consumers?
Yes, if you look, we had a good first quarter, very, very good top line, even stronger bottom line. But yeah, we want to be cautious for the rest of the year, see what's going to happen with the consumer on one side. On the other side, We're not quite clear yet what's going to happen to cocoa costs and what we might have to do in pricing going forward. So it's probably best at this stage to stick what we have for the year and see how the second quarter is going to fold out for us. And then we can have a much better look.
Before we let you go, my Instagram feed has not stopped with these Sour Patch Oreos. How does an innovation like that come about, and why do I need this in my life?
Well, you need it in your life because it's just interesting.
That's a fair point.
and fun. But today's consumer likes to experiment. They like new things. They like abnormal things, strange taste, and so on. And so that's really what it's about, to create more interest, to get a spike that everybody's talking about. And, of course, trying the product and see if they like it, yes or no. And you need to constantly come up with new news. And, yeah, so Sour Patch Oreos is one of those things that particularly millennials and Generation Z get really excited about.
I will just say for the record, Dirk, I am not poo-pooing this innovation. I love seeing food innovation. I will give these a try, and I will report back to you. Mondelez Chairman and CEO Dirk Van de Put, thank you for always making time for Yahoo Finance. We always appreciate your time, especially on a busy earnings day.
Thanks for having me, Brian.
FI shares sliding today after the company delivered mixed second quarter results. Profitability was a positive, but net revenue missing expectations, as did third quarter guidance. Here with more is F5 CEO Francois Locoh-Donou. Francois, it is always good to see you. So let's just get right into this earnings report, Francois. Mixed relative to expectations. It does look like that Q3 EPS guidance was disappointed, Francois, at least relative to consensus. But walk us through the print. What drove the quarter?
Well, we delivered a solid Q2 with revenue near the midpoint of our guidance range and earnings per share at the top end of our guidance range. And we also took the opportunity to reaffirm our guidance for the year and in fact increase our earnings per share guidance for the full year. And all of that was driven in part by strong growth in software and most notably software subscription that drew 28% in the quarter. So overall, we're pretty confident on delivering to the expectations for the year. There is some volatility from quarter to quarter, and a little bit, I think, of disappointment today on the Q3 guide. But we feel very good about the full year and the guidance we've given.
Francois, talk to me a little bit about the how clients are feeling right now, because you did mention on the conference call that there are what you called lingering macroeconomic concerns and generally flat IT budgets for this calendar year. What are you hearing from clients, and then how is that flowing through to what they're spending on your products?
Well, generally, the environment this year is more predictable than it was last year and more stable. However, for the most part, we're seeing large enterprises are still cautious on their spending environment, especially at the beginning of the year with their budgets just being out. I think enterprises are a little cautious on spending on CapEx. And generally, we expect budgets this year to be maybe flat to slightly up. But at the moment, folks are cautious. The bigger trend, though, is that we're seeing enterprises are in a pretty significant crisis because delivering their applications has become extraordinarily complex. Enterprises have applications that are distributed across multiple infrastructure environments, multiple clouds and on-premises, all connected by an exploding number of APIs. And delivering and securing these applications has become extraordinarily complex. We called it on our earnings call the ball of fire, and we think the ball of fire is a pretty significant problem for enterprises today.
And I'm curious, Francois, just looking ahead here, second half, as you kind of focus on reaccelerating growth, how do you balance that, Francois, growth and profitability?
Well, we're going to continue to be very focused on our cost controls and continue to be very disciplined around our spend. We have committed to our investors. We will continue to drive double-digit earnings growth, and we are doing that. We did it last year. We expect to do it this year as well. So we're going to continue to drive profitability, but we see a good opportunity for growth because we are in a unique position to solve this complex issue of the ball of fire for our customers, because we've positioned F5 now to be the only company that can secure, deliver, and optimize any application or any API anywhere in any cloud or on-prem environment. That gives us a unique position. And we're also able to radically simplify the process of connecting applications between cloud or between on-premise environments and cloud. And that gives us a strong growth opportunity, particularly in software, in coming quarters and years.
You and your team also talked on the call a lot about how the demand for new AI-empowered, generative AI-empowered applications and other functions should also increase demand for your products. Give us a little more color and detail around that and what you're seeing already in that area.
Well, what we are already seeing is that the AI and AI implementations are going to exacerbate this problem I just described as the ball of fire, because AI creates more workloads that are more distributed, that need to access data in more locations or services or models in more locations. And all of that needs to be secured. And so it exacerbates the problem. And so we are already seeing opportunities, for example, in securing the APIs that connect all these workloads together. we are already seeing opportunities. F5 has invested to have the most comprehensive and AI-ready API security solution. And that solution is creating already opportunities for AI workloads. But as enterprises move to deploying AI in enterprise environments in the next 12 to 24 months, we will see that accelerate because there will be need for more APIs that will need to be secured. And we will be positioned to take advantage of that opportunity as well.
Francois, I'm curious, just as you kind of look across your portfolio, product-wise, Francois, what are you most excited about?
Oh, I'm most excited about F5's capability. We're essentially the only player in the world of application security and delivery that can support customers in hardware, software, and SaaS. And that combination is unique for all large enterprises that have a legacy infrastructure, but are modernizing that infrastructure, want to implement AI, want to leverage public cloud, but at the same time, need to continue to secure and deliver their applications that are on-premise. F5 has a unique portfolio that brings all of that together and radically simplifies their ability to connect their applications across multi-cloud environments and secure those applications. So it's the combination of hardware, software, and SaaS that makes F5 unique in the landscape of players today.
Francois, as always, it's a pleasure to see you. Thanks so much for joining us.
Thank you.
Coming up, we're diving into a few other earnings reports from today, including the latest from Supermicro Computer and Caesars Entertainment. Stay tuned. More Yahoo Finance after this.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Let's take a look at what's trending after hours. Starbucks shares sinking as the company missed earnings expectations across the board. Adjusted earnings per share coming in at 68 cents versus estimates of 80 cents on average. Revenue of $8.5 billion coming in below the street's estimates of about $9.1 billion. And probably most notably, same-store sales unexpectedly contracting by 4%. And falling across all regions. It's the first quarterly sales decline overall since 2020. The company's CFO, Rachel Gary, will be joining the morning brief in the 9 a.m. Eastern hour to discuss those results.
Meantime, shares of Supermicro Computer also under some heavy selling pressure here. The AI hardware manufacturer stock initially did jump as much as 10% after posting its fiscal third quarter results, but revenue came in at slightly below Wall Street expectations. Company's sales outlook surpassed analyst expectations, signaling robust demand for AI hardware.
And we're also watching shares of Caesars Entertainment. Those shares down after the company's revenue for the first quarter did miss analyst expectations. Caesars CEO calling out a number of headwinds in the earnings release, including, quote, unfavorable outcomes for the Super Bowl and March Madness that affected the company's hold in online sports. Also, we wanted to recap what we were seeing from Amazon and talk about some takeaways from the Amazon conference call. As we discussed, the company's numbers last quarter, particularly for AWS, were a standout, even as this current quarter's forecast fell a little bit short of estimates. Our Madison Mills sending us some of the highlights from the conference call, and just to bring a couple of them in. Interesting here, leap year apparently helped first quarter sales by 120 basis points. The company is talking about the momentum that they're seeing in AI that is driving customers to sign larger deals with longer commitments for AWS, which I thought was quite interesting as well.
Yeah, I mean, the focus, though, to your point, Julie, it really goes right to AWS because that is this company's profit center. And listen, they turned in $25 billion. That was up 17%, and that was a beat. Analysts were closer to about $24 billion.
And one quick note on headcount as well that Maddie pointed out that I thought was interesting. They are increasing some headcount. It's driven by associates and operations. They're hiring in generative AI, but most teams, they say, are working to keep headcount flat, which is probably something that investors want to hear. All right, that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 2 p.m. Eastern for all of your Federal Reserve coverage leading up to and after the closing bell. Have a good night.